The US national debt has jumped by a whopping $11 trillion over the last 4 years. By comparison, it took the US 220 years to add the first $11 trillion of debt. Rising debt levels have helped the economy and markets prosper through periods like the pandemic and the aftermath of the Great Financial Crisis. But today, debt levels continue to rise rapidly despite no clear ongoing crisis. But this isn't just a US problem. Across the world, many developed countries are facing unprecedented debt levels. In Europe, France and the UK have seen their national debts soar, and ratings agencies are sounding the alarm. In May 2024, S&P Global downgraded France's credit score. They gave it a negative outlook. And recently, S&P Global and Fitch urged the UK government to keep a tight rein on spending or risk another downgrade. In Asia, China, Singapore, and Japan are all examples of large economies that also saw their debt soar to unsustainable levels in recent years. The total global debt load today stands at a staggering $305 trillion. But at what point does the world have too much debt? We'll try to give an exact number in this video. Does that even exist though? Theoretically, debt levels can go infinitely higher. The problem comes when debt becomes much larger than the size of the actual economy that pays for the debt. In the United States, for instance, it has seen its public debt soar by $25 trillion over the last 15 years. But the United States GDP, on the other hand, has not been able to keep up with these rising debt levels. In other words, the debt load in the United States has become larger than the actual economy, about 120% larger. So something called the debt-to-GDP ratio now stands at 120%. And when we look at the last 60 years of data for this debt-to-GDP ratio, we see it currently stands at one of the highest levels in history for the U.S. A high debt-to-GDP ratio is a problem because the economy is what pays for the debt. If the economy is much larger than its debt, tax revenues easily pay for the nation's debt. This is good for economic growth. If, on the other hand, debt is much larger than the economy, the country will need to raise its taxes and cut spending in order to pay its debt. This is bad for economic growth. Academic research supports this. Countries that have a debt-to-GDP ratio of about 30% typically see strong 4% economic growth. But as debt levels rise, the amount of economic growth they can expect dwindles down. When debt to GDP is above 90%, economic growth is at a mere 1.7%, half of what a country without debt can expect. This 90% level seems to be where things go sour for debt-burdened countries. Not only does it kill growth, but it also leads to higher interest rates, and that is what can lead to a full-blown debt implosion. This research paper from the IMF discusses this. It concludes that with each percentage increase in debt to GDP, a country sees a 20 basis point increase in interest rates. So as you see the debt to GDP ratio reach 90%, you can quickly understand how much of an impact it has on interest rates. Higher interest rates means higher interest payments. So in other words, the debt becomes more difficult to repay. Imagine you owe $1,000 to the bank at a 5% interest rate. That means you owe $1,050 to the bank with interest. But all of a sudden, the interest rate rises to 50%. Now you owe $1,500, and you might not be able to pay all of that money back. That is how rising interest rates can cause bankruptcies. So is this what's ahead for major economies like the US, UK, Canada, and Japan that have high debt-to-GDP ratios? Are rising interest rates going to lead to debt defaults and economic chaos? Actually, probably not. Unlike you, these countries can print their currency. Of course, it would be illegal for you to print fake dollars in order to pay your debts. But Japan can print yen, the UK can print pounds, and the US can print US dollars in order to pay back their debt. They can even use this money printing to keep interest rates artificially low and make it easier to pay their debts. This is what central bankers call quantitative easing. This money printing and quantitative easing is why a classic bankruptcy is a very unlikely scenario for most developed economies today. Sound too good to be true? That's because it is. Printing money in the local currency can lead to a devaluation of the currency, or what's called a currency collapse. Take Japan, for example. Japan has the highest public debt to GDP ratio of any economy, a whopping 252%. This means that Japan's debt is 2.5 times the size of its economy. Japan's GDP has been flat since the 1990s, while its debt levels have soared since then. The gap between its economy and debt load has only gotten larger and larger in recent years. They've printed money and done quantitative easing during this period, and as a result, the Japanese yen has been one of the weakest currencies among developed economies, losing 35% of its value relative to the US dollar since 2020, and almost 60% of its value since 2011. It could be that Japan eventually gets its debt situation under control and reverses the trend, but if they fail to, it could spell more trouble for the currency. The UK also has a debt-to-GDP ratio above 90%. Although it's much lower than Japan's, it does stand at the highest level in the last 60 years. The same goes for the US, Spain, France, and Italy. According to academic research, this is where debt troubles can start and where currency devaluation can start to happen. Germany, on the other hand, has managed to bring down its debt levels over the last few decades, showing everybody that responsible government spending is something that is possible. Of course, Germany shares a common currency with Spain, France, and Italy, the euro, which ties all of their debt burdens together. The euro area as a whole has a debt-to-GDP ratio of 88%. That's not catastrophic, but it's also not ideal. If these nations wish to avoid damaging the purchasing power of their populations and putting a heavy debt burden on future generations, it is important that they focus on bringing down these debt-to-GDP ratios. For investors, we can use this information as a tool to understand how currencies are trading against one another, which ones are the least likely to hold their value, and which ones could appreciate.